morning, everybody. As mentioned, my name is Mark Van Wyk. I head up unlisted investments at Diligence Investment Managers. So we currently manage about, in the unlisted space, about 3 billion rand of asset under management. As a house, we manage about close to 40 billion rand. In terms of the unlisted space, we've got presence in a number of different jurisdictions currently, including Namibia, Lesotho, and also Swaziland and South Africa. We mainly in South Africa invest in impact investing, both on the credit side and on the equity side. And then also, mainly our focus on the equity side is mainly in terms of infrastructure and development as a strategy for investment.
Thanks a lot. My name is Paul Kamau. I'm one of the partners directors of a licensed investment transactional advisory firm based in Nairobi. We are focused on Africa operations, of where we get involved in funds, sometimes on the sell side, and then other times on when the fund is going to a space, and we sometimes handle the buy sides. In terms of due diligence, it's much more of, and fund operations is much of what we see, what you have seen, what you have gotten involved into, and mostly where we have burnt our fingers on.
Hi, I'm Anjali. I'm from Dentons. I'm head of private equity and investment funds for Africa. We are the largest law firm in the world, but we have a real focus on Africa because we really believe in the growth. I've got 20 years of experience in the industry all around the world. So I started off in Europe and Asia and now in Africa. So I have a good kind of comparable base of how things work elsewhere in the world, and we're able to use solutions from other regions and see how they could apply in Africa itself.
Brilliant. Thank you very much. I've had a number of conversations this morning about political risk in Africa, and the issue that keeps on popping up in a number of conversations is the issue of trust. Trust. How can you trust a government in Africa as a fund manager? Now, just based on the presentation I mentioned earlier, maybe circling around our issue of operational risk, how are you putting measures in place to mitigate operational risk within a fund and try and build up confidence and trust within working in Africa? Is operational risk therefore different working in Africa than in other places in the world?
So just from a legal perspective, one thing that we look at is bilateral investment treaty protection. So, for example, your fund, if it's in a jurisdiction which has some really good, robust bilateral investment treaties with some of the African countries, that offers a level of comfort. So Mauritius has been really, we were talking about Mauritius earlier, that's been really, really good in actually negotiating these treaties. And I think South Africa has been in the process of actually terminating its bilateral investment treaties, but it's retained it with Mauritius and a couple of other regions. So, that's one thing that we would look at on the legal side.
Yeah, I think from an operational side, Robert, so yes, that we always find government being on various different sides of the table in terms of a transaction or a business. It's either they're supplying you with product or you're supplying product to them. And in cases, what we've seen in South Africa specifically was in the government's off-taker. It's been it's kind of written everywhere in terms of government itself is probably grinding the economy to a halt in terms of its payment profile and paying very slow to medium and large size businesses, including small size businesses. So the regulatory framework in South Africa is relatively robust to give us that level of protection in terms of being able to challenge government and being able to take it to court, whether it be a water board or a municipality, etc. And you have the regulatory protection there. So obviously a recent case in point, very topical for us currently as infrastructure investors, is the potential renegotiation in terms of the tariffs on the independent power producer program. We never thought that it might happen in South Africa after what happened in Eastern Europe. But it's currently on our doorstep, and we have to kind of see as to how that plays out. So I think also, working with governments, etc., in terms of the fluidity, in terms of how changes happen. You spoke about nationalism, populism. We have to be on the lookout for some of those things. we're fortunate enough in terms of our foreign jurisdictions that we actually raise money in those local jurisdictions to deploy in that jurisdiction as well, as opposed to taking money from South Africa to deploy in those jurisdictions. So that kind of gives us a little bit of a shield, but still, even doing that, we're still exposed to that risk. So I think maybe some fund managers don't pay enough attention to actually that political risk component of it and how it might actually impact their portfolio companies directly or indirectly.
What happens is that, and actually it happens more often than not when you're doing, like, let's say, business modeling, financial modeling. It's unfortunate when you come to Africa, sometimes we tend to tie, let's say, the expected life or the model to the political life in a country. So let's say when somebody wants to come and do some funding, let's say in Kenya, the first thing they ask is, when is the next elections? When they come to, let's say, any other place, do you think the next election so-and-so will win? Because what happens is that the governments, unfortunately in Africa, we tend not to have a lot of continuity on the projects. So you find there is, I give example, you'll find governments comes and they say maybe they are focusing infrastructure. Midterm, maybe they will not have finished the whole. By the time a new government comes in, they're talking of something else. And you find now what happens is what some funds will like to go not long term, but they just want to recoup their investment within the space that is predictable. I think that's one of the uniqueness in terms of politics that is there. And the other thing that happens is that we are not mature enough. Not it coming out badly, but you find that let's say populism comes into Africa, and the new government comes in, changes the whole wavelength, new taxation, new space, and everything. So you find when you are tied to that politics, it becomes less predictable compared to more developed economies. Okay.
Are there any fund managers in the room not from Mauritius? There we are. So, are you absolutely right? Mauritius does provide a special purpose vehicle, a risk mitigant for funds operating in Africa. And you're absolutely right as well, Paul. If you're looking at a place like Kenya, people immediately ask, when are the next elections? And you see a real drop-off as well in investment, in growth, in interest in a country, sometimes right before the elections. Botswana was holding elections, was it yesterday? Still got elections coming in Namibia, etc. Potentially talked enough about political risk. Let's maybe focus a bit about due diligence. And again, over to you. How does due diligence change from your perspective as fund managers when you're looking within Africa? Are there specific considerations that you hold for due diligence or conducting due diligence in Africa?
One thing about due diligence is all about knowing better, making an informed decisions. However, one of the key challenges is about the reliability and availability of data. Which data do you have so that you can assess company X, company Y, company Z? That's number one. Number two is that data accurate? For a long time, the source of undisputed data used to be auditing firm. Forgive me if you're an auditor. But more often than not, you find now there's a lot of conflict. They say company X failed, company Y failed, but you find these accounts were audited. And then you ask, when due diligence is done further, then you find that maybe what was being presented may not be as factual as it would be. There was some estimate, there was some judgment that maybe have done that could have distorted the figures. That's number one. Number two is the challenges in Africa is that most of the organizations that comes in, the types of the sector they're coming in is not quite scalable. So you come to ask yourself, I give example. If I go to value a company in Europe, I give for example, I look for comparables. I'll find good listed companies. You come to Kenya, I give example, all African countries, there are very few listed companies that will get what are the comparables to get the information. So that becomes a bit of a challenge to the fund people who are coming to that space. And sometimes it's they just say, let's hit and hope that all will be well. But when you hit and you hope, the outcome is not always guaranteed. Then the other one of which is quite challenge about it is that people have coming to understand the importance of the sales side professionals. So we'll come and pack the business well, and at the end of the day, the sales side, they know they're selling ice to Eskimo. By the time the fund manager comes in, find he was an Eskimo, he has ice in his hands, what does he do with it?
Okay. I completely agree. The quality of the information on your portfolio company is a huge hurdle in terms of doing due diligence. And I think also tied into that is actually just how portfolio companies operate. So, their corporate structures and the governance that they entail themselves can make, again, information difficult because they just don't have the processes and protocols in place. That means that in documents we end up with lots and lots of representations and warranties whenever conducting deals with the portfolio companies. But again, you get into enforceability. Are you really going to sue your portfolio company? So it's a tricky issue. I think corruption is also a big point that, I think we have to focus on probably in more detail because that also has risks for the fund, reputational risks, but also legislative risks. So again, really talking to the people on the ground, having those discussions with management is key to really ensure that you have the trust that maybe you haven't got from the documentation.
Yeah, I think also maybe just to add on to that as well, I think what we've experienced as well is that finding the rightly qualified service providers to assist in terms of execution of due diligence in some of these jurisdictions is slightly difficult, especially with relatively, how can I say, new or nascent kind of subsectors in the economy. It's very difficult to find the right quality of people to assist you in terms of that due diligence process. And then in most cases, it normally takes a little bit longer than what we really anticipate. And it's more intensive. So we've been, on the renewables, for example, or the water infrastructure, it is relatively difficult for us to find those qualified people because those transactions are so far in between, and then you normally have to bring in other parties from outside that local jurisdiction to assist you in terms of the execution of that.
Just from my perspective, obviously we are a service provider conducting due diligence around the continent, also based in Mauritius for many reasons, the same similar reasons as the funds. It's obviously very many different layers of due diligence. And I think I wanted to ask the question to the panel as well. Does, from your perspective, from a fund perspective, does it change as you perceive or how banks are affected by regulations, by the Basel processes, etc.? Do you find potentially that you're moving into the same direction through the same regulations, etc., in different jurisdictions, that it's becoming more important to conduct due diligence these days on African projects, African relationships? Or do you find that actually the fund industry generally is still very much contained from those rather cumbersome banking legislative processes?
Maybe I'll just a few opening remarks on that. So from our side, we mainly conduct leverage acquisitions. I think we invest in quite bulky, chunky assets, and so in most cases we will have either a local bank or international bank co-investing alongside us. So, and in those cases we automatically kind of have to comply with any banking regulations with regard to our counterparties, which is from our side somewhat comforting to know that sometimes we lose opportunities because of the owner's requirements, but in other cases, when we do close, we take a relative level of comfort to say that we've partnered with parties looking at the transaction with different lens and give us a higher probability of success in terms of realizing our investment. So, and I think with the Basel codes, etc., banks are becoming a little bit more can I say, restrictive in terms of their conditions. But as partners in this game, we kind of have to play together. So we take it on the chin and we just keep moving forward. And I think the bar has been raised for us. Sometimes I think when regulations take the banks out of the equation for certain opportunity sets, it's opportunities for us to step in, and where we take the front line and they kind of support us in the back, where historically they used to kind of run in the front. Yeah.
One of the unique investments, and you'll agree, sometimes the size of the deals that are on the continent. You'll find that if a deal that is above a particular threshold, it's either with the government, transport and infrastructure, or it is in an institution that the government has control. That's bringing risk by itself. Because what happens is like now when you're coming to do due diligence, you're being forced to do due diligence on the government. On the upside, if you want to go purely private where there's no control of that, you'll find that the people who are being approached or who have that deal, they have been oversold the money because there's actually a lot of fund money that is floating. So sometimes some concessions are being done by fund managers, and you'll find that what you are holding, maybe it was not a good deal because the person, the suitor, had a lot of opportunity. And the sizes of the deals will always keep on challenge. You'll find that maybe outside South Africa, to get a deal of, let's say, $15, $25 million, you'll have, you'll be fortunate in terms of that, other than small-scale infrastructure. So, it's to support what he has said. Now, when that is involved, and we are not saying the corruption comes in, you'll find now the due diligence becomes a murkier event and affair to get into.
I think also just remembering the regulatory changes and the fact that, a lot of jurisdictions are fast-moving, sectors are opening up. Actually, the regulatory due diligence is very important too. And being mindful of what might happen in the future. So, one day you might be able to do business in a certain sector, but, in 5 years' time, that could completely change, going to the political risk. So how you monitor and do due diligence on that is really important, and you can really kind of look at lessons learned in other jurisdictions, see trends maybe in countries that are advancing at a different pace to see what might happen in your jurisdiction. But it's an important point to keep in mind.
There's I think a point that you had hinted to, and I think I listened by the panel that was here about Mauritius. And for me, I think it is there to stay for a long time. And this is my opinion. You find like if I'm in South Africa and I'm trading with Botswana or any other continent, you find the taxes become so punitive. Okay? You find there are few countries which have a double tax agreement. So I'm getting a lot of exposure in taxes. And then you find it doesn't become worthwhile. So, but if I go to Mauritius and I present myself as a Mauritius company, I'll get tax concession in Kenya, Tanzania, Zimbabwe, everywhere I go. And then the question is, as a rational investor, why don't I go and set up in Mauritius? At the end of it all, it's not about love. It's about the business that was on the table. Why should I give an example, and still be based on Kenya. Kenya, there are very few tax arrangements with Tanzania, the next door neighbor. So you'll find if I go and offer services in Tanzania, the effective taxes that will be charged, it just becomes so high. And I think it happens on vice versa. But if I was to go to Mauritius, I'll come and find that I get sufficient tax breaks. Even sometimes you'll find that even dealing with your own country, sometimes you're better off appearing as a foreign investors because the incentive, the tax breaks and all that, they're better than a local. So I'll go outside the country, close to our border, change my skin, change my suits, and I come and say I'm a foreign investor, and I'll get all the tax breaks. And I think it's a gap that's needed to be well thought out. especially on the effectiveness of FDI, because most of these is purely your money that has been clothed as a FDI.
Thank you for that. I wanted to ask the panel as well about the nitty-gritty of hiring an investment manager, etc. But if there are any questions in the meantime, then please don't sit on them. Please do raise your hand if you have one for the panel. Or while we continue, just feel free to raise your hand and ask a question. In the meantime, I wanted to ask you about the process of hiring an investment manager within a fund. Or assisting in the process. How do you research the investment manager? How do you go about? What are the processes involved in the hiring of an investment manager?
Okay, so being a fund manager myself, probably sitting from the other side of the table in terms of being scrutinized very carefully by whether either direct institutional investors or consultants that's been appointed by institutional investors. I think what we do see in the market currently, especially in the alternative space, is that, in a South African context, that is that given the benign performance on the listed market, whereas historically we used to sell alternatives as a second-class kind of citizen. We're now kind of on the buy list from not most institutional investors, but those institutional investors that have the wherewithal to actually understand what it takes to buy an alternative investment manager. I think the competencies historically has kind of remained very well kind of protected within the DFIs and maybe a handful or two handful of institutional investors in South Africa. So what we see currently is that we're seeing consultants and funds itself, on the steep learning curve, trying to develop an ecosystem that can assist them in terms of making the right calls on managers. You also have a big influx of new managers coming to the market, and some of them, with some great investment theses, and others they're just thinking it's relatively easy to kind of make money in the alternative space. Look at a couple of screens and press a couple of buttons and you've got a couple of good investments, and you sit back and you wait for the money to roll in, and you pop the champagne bottles and drink out the carry before it's even there. So what we have seen is that clients are becoming a little bit more astute. The questionnaire sets are becoming longer, more detailed. Before historically, sometimes they used to make an allocation before coming on site. Now they come on site. They chat to the entire investment team, straight from the junior analyst to the head of the institution, trying to see for consistency in terms of the investment process, the strategy, who's doing what. And so that's on the people side. Kind of have to prepare lots of files for clients to see it documented, investment process, in terms of how robust is the process, how repeatable is the process. So we constantly printing decks of paper to give to consultants or clients to give them comfort that what we say we're going to do is what we have historically been doing and what we will continue to do going forward. So that's on the people and the process side. And I see a bigger emphasis, I think also probably a big proponent for that, is that the industry in the sector is human resource intensive. And sometimes, depending on the strategy that you're looking to play, if you've got a growth strategy, you're probably going to have a lot more people to assist in executing that growth in your post-investment process, as opposed to just running a passive, non-value-add strategy in a portfolio company. So you need to have the right caliber of people, and so investors are looking at that now. There's a number of counters per investment professional, and then also outside that is obviously the administration and the support services, and now, there again, we have to sit on the other side of the table and due diligence our service providers to give our investors the comfort that they're getting the right service. So the process, is becoming longer. There's more parties at the gate wanting to come in. but you still have to make sure that your house is in order when they come.
I think something that needs to be clear, the mental kind of framework that whenever there is a client and a fund, is that some of the investment, some of the relationship ought not to be there. Okay, it's not always that a company and a fund that they match in terms of perspective, in terms of the ethos, in terms of the profiles, in terms of the outlook. And whenever something is forced, and there's a lot of due diligence that actually is done by the fund to the prospective, let's say, companies. But I think the challenge is always the company, more often than not, they don't do the due diligence on the other way side. So they find they have seen dollars on the table, they say yes, and they sign anything on the table. Only sometimes they don't ask themselves, other than the money, what else is on the table? Other than the money that you're being given, or even this money that is being put here, or even this investment that is here, what condition does it come with? What was the perspective of the fund? What were they looking for? If that thing never matches, and if it doesn't match, what happens is that later on there will be conflict. You think the investment manager was incompetent. You think that the investment deal was not bad. But I think from the word go, it has not been conceptualized well. And I think that's one of the challenges that we find day in, day out. You find what was in the table, what was it that you are thinking you are getting yourself into. On both sides, sometimes it becomes blood. And down the line, it just becomes a lot of conflicts on both sides. And then you find, more often than not, maybe the investee never sat down and asked, other than money, is there any other benefit?
I think that really, obviously, checking the fund manager's experience is critical, but also looking at how robust their processes are. So when they have an investee company, what due diligence do they do on that company? Do they just say, sign on the dotted line, or do they actually do a thorough due diligence? Talking to them, understanding what process and protocols they have in place is really important so that you know your money is protected when you give it to these guys. I think also, obviously, knowing your key persons, but then also understanding the support network that the key persons has. So what service providers are they using? Are they merely just outsourcing everything, or are they actually really taking responsibility at the end of the day for everything that is happening? I think, understanding the pipeline, that how experienced are they in the market that they're looking at? Again, understanding their background is key. I think they're the things my clients definitely look at.
Absolutely, yeah. It's a very good point. Still on, yeah. Let's talk about some of the due diligence tools. We talked about service providers. We talked about this, Paul, you talked about this earlier as well. To what extent is data analytics actually useful in due diligence process? Or what other tools would you recommend when you're conducting these types of due diligences?
Lawyers. Slightly biased answer there. I think obviously the financial side is key, and I think, as we've said here, with unlisted companies, that financial data is very, very difficult. So you do get specialist companies that work with unlisted companies and understand how to extrapolate that data. So they're quite important.
What's happening is the due diligence is becoming complicated. Let me give an example of something that we did. So this time that we were doing a due diligence, we were on the buy side. And the client, now the fund said, I want you to do due diligence, give us your third-party opinion on the value of this company, and please tell us much about what you think about it. Is it a worthwhile investment? Good. We got the financials. Everything was ticking well. We got financials. Everything was well. The presentation was good. all was well. But then we ask ourselves, why don't we get access to the servers of the operations? Other than the data on them, we made $1 million, our total turnover was X amount of dollars. Why don't we get to the server and we try to come and segregate the information? So like, for example, if it's a mall, and you're talking about this kind of turnover, I need to get some corresponding numbers about the number of shops, the number of people who walk in, the number of revenue per person who comes in, and all that. When you are able to get and to look at all that set of the data in-house, we found some inconsistencies that we just went back and asked ourselves, how did you get this information? How did you come to these accounts, well audited, well presented, and they were all flowing? When you start now poking information one by one, that was the easiest fees that we have ever gotten, because we went back and we said we could not assess what is the true position of the company. So what I'm saying is that in terms of due diligence, the companies have become sophisticated on how they store their data. In due diligence, we need to get exactly the same sophistication to get the same data and to be analyzed. We are talking of someone handling several TBs, terabytes of the data. You just have to come with a system that can match up to that. So in our space, we think that the companies, in terms of due diligence, that are continuously investing in the tools, sophisticated, and able to customize to the few clients that are being done due diligence, the better they are. Otherwise, you'll do disservice to the other side.
Yeah, I think from our side, I think obviously we have to place reliance on some data. It's very impossible for us to go and review every piece of information that's out there. And so we tend to focus a lot more on the critical elements of, the investment case. And what we found historically is in our operational due diligence, focusing on the customer database and having some external, in most cases we actually do get our commercial advisors to assist us in terms of those components of it, because we don't have that competence internally to actually do data analytical tools or run scenarios on information. However, we can craft scope of works for them to make sure we get the right results out of it that we want to see. And then similarly also for our technical due diligence components of our infrastructure projects. There we obviously rely on our external technical advisors, whether it be owners, engineers, or lenders, technical advisors that have the necessary tool sets internally to assist us and give us the level of confidence and review that the information that is presented to us have been tested. And so I think as fund managers currently, because we also do bespoke transactions, we're not specifically one sector focused, so it doesn't really make sense for us at this point in time to over-invest in that kind of tool sets and rather rely on external service providers to assist us in execution on that side.
Can I just add, I think one thing that is very important as well is not ignoring the alarm bells. When you go and you ask for something and someone's cagey about where, the information is or what's available, trust your instinct. There's something possibly being hidden there. It's not that they just don't have it. So, I think really talking to management and really trying to suss out what is going on and using that instinctive talent of yours is actually really critical when you do due diligence in some countries.
Absolutely. I think I actually wanted to chip in here slightly as well on the issue of due diligence. We obviously are a specialist intelligence company ourselves, conducting these types of investigations quite regularly. They really vary in scope, in size, in cost, and also whether the opinion is actually taken or not. And I remember it was 2 years ago in the Democratic Republic of Congo. It was an 8-month investigation, about 18 different cities. We had people on the payroll, etc., in different cities, traveling around, literally going to to the extent of finding out who's sleeping with whom, essentially. And on the other side of the spectrum, can you ask your local guy in Dakar or in Cotonou to walk down to the registry office to collect the quick, corporate documentation? The scope in time, in cost is so very different. And of course, it goes back to the issue of regulatory compliance. It also goes to the fact, whether you want to go with your instinct or not. I think my question is, to what extent does due diligence actually affect valuations? And to what extent does it actually affect asset allocations as well? Back over to you.
I think it does affect valuations, because if data is missing, or if you feel that there is a risk because it's come out from your due diligence, then you factor that into the price. So that it's part of risk is part of pricing. So yes, I do believe due diligence is important in that.
It affects, and actually, it's one of the most critical components in the evaluation. As she as well put it, whenever you're doing evaluation, the first thing you ask yourself, what's a risk that this entity will get exposed to? And there's sometimes you say this valuation cannot stand because of factors that A, B, C, D. I give example. Whenever you get a company and you want to do valuations, one of the things that is always a bone of contention is like, what's the discounting factor? That discounting factor is how it's arrived at, how it's computed, is a factor of what's the risk I think this entity will be exposed to. The more you are getting involved in the due diligence, the more you think the riskness of that asset. And in asset allocation, it's all about return and the risk. So if you do a good due diligence, you'll be able to size up the risk, and that it will affect the returns. In terms of the valuations, the more riskier it is, the more less value it is. And so if you don't quantify it well, you'll do injustice.
Yeah, so in most cases, we kind of, like in our equity side, buy hard assets. So we need to get a firm handle on, what we see or what is in the report is really, what is on the ground. And in most cases, due diligence is, what we do is a buy, no buy decision. If we identify something that's a fatal flaw, doesn't matter if we're 18, 24 months in the due diligence process and we believe that it's been concealed from us purposefully, just leaves a very bad taste in our mouths, and we'd rather walk away from the 24 months spent on evaluating transaction and focus on looking for something new. So it's a buy versus no buy decision, and then obviously subsequently where we can transfer some of the risk of some of these findings that we have identified back onto the seller as part of the process, especially where we're in a competitive bidding process, which is in most cases in infrastructure, in a competitive bidding process. You want to make sure that whatever risk you've identified, you can actually pass back to the seller. If the seller is willing to keep it, the price kind of remains the same and you can continue going forward. If the seller doesn't want to take it, then you're basically back to the drawing board and adjusting the purchase price. So, and I think obviously for us also, part of the due diligence isn't just the historical stuff, but also the future. And making sure that we've got our finger on the pulse as to what's going to happen going forward in the business and the management teams and the environments we've invested into. So it's critical in terms of that buy, no buy, high, mid, or low price decision process. Yeah, and I think obviously we kind of like to pride ourselves that we kind of make money when we buy the business as opposed to when we try and sell it. So we want to buy at the right price, unlock our value add strategy, and then and not really have to work that hard when we actually have to exit the asset because it's a quality asset. But we've done our homework properly.
I think just picking up on that point, actually it impacts the rights and things that you might want to put in your documentation. So if you feel that there's a hole perhaps the CFO is not performing the way that you would want him to, or doing the financials the way you'd want to, you might ask for a right to nominate the CFO, for example. So actually the due diligence can really help iron out what protections you might look for in your documentation.
Thank you. I potentially have one or two more questions for this panel, but I'm not allowing us to break up for lunch until it's at least 2 from the audience. Graham and Myra are guarding the door to let you leave before lunch. Actually, are there any questions? There's a question over there. Maybe there's a question. Graham, you had some probing ones early, and a second one over there, so you're already fine. Please go ahead, sir.
Hi, I'm Charles Buchanan from IKEQ. It's good to meet you, Anjali. We met on a video conference. I flew to Joburg and video conference to her in Cape Town. So a bit of a mix-up.
Good to meet you again.
Something that we've discussed during that call was the technical support that fund managers are required to provide their portfolio companies. And I know Mergence quite well. They were clients of mine in a previous life. And that it's a reasonable size operation, but you're not massive. So how demanding is it for you to provide that technical support that your portfolio companies need? Because ultimately the financial reporting, governance reporting that comes out of your portfolio companies is what your LPs want to see. And at what point do you have to call on service providers, accounting firms, governance firms to come and help you? And is it something that's becoming more important? So that came from a conversation that Anjali and I had last week.
Thanks for the question. And I think it was meant to another panel. It just goes back to 2 things. Sometimes the funds need to be carried themselves. And they say, maybe this organization requires a particular technical support, and we may have limited, or we may not have it, but you're willing. So what I've seen that is happening is that the fund, they contract, let's say, an entity or a service provider, and they can be giving support to that. I've seen that is common. Number 2, and this comes back to the due diligence. If when you're coming to due diligence, you have been able to pick up at least major issues that the company needs. When you're coming to structure the investment, you will consider on how are these things going to be addressed. You may say, we have noted that your company has X, but it has this kind of shortcomings. It's a good company if we tackle the shortcoming. How are we going to tackle the shortcomings? Now that becomes part of the agreement. But if that thing was hidden, then it means that in the whole investment life cycle, it will be ducking one bullet another bullet, because you're hiding what you hid during due diligence. When it comes up again, you hide it, and then you find you're not even given the appropriate technical support. So yes, giving technical support is becoming a big thing. And if it's not being given in-house, funds are contracting maybe service providers to offer that service.
Yeah, when it came up in our conversation, it was really in the context of SMEs. And obviously, a lot of companies in Africa are very small. And it's not just that they're hiding data, it's just that they don't know how to collate all that data and put in practice or put in place good corporate governance practices. So we see technical support or technical assistance being more and more widely used to help grow and accelerate those companies, and in turn, obviously, improve the investment returns.
Yeah, I think from our side, obviously from the impact investing side, the TA is very, very important. As the deal size becomes smaller and the stage of life of business is relatively early stage, and so to deploy R1 billion into 50 million rand check sizes becomes a big problem. So in terms of obviously portfolio construction, we have to kind of gauge, how far we're stretching our internal capacity. And I spoke earlier about, the key metrics of actually running the fund from an operational perspective to making sure that you're in balance still. So for different kinds of investments, at least, this is very top of mind for me currently as the head of this business unit, is that, you've got different kinds of businesses that requires different levels of attention attached to it. And if you've got a normal PE fund, non-sector specific, just investing in early stage growth businesses, there you kind of you're scrambling all the time. You're stretch defense, close defense. You're all over the place. When you're investing into the more mature infrastructure businesses, big size businesses, where you're co-investor, where you're not just you've got other co-investors alongside you that has been down this journey before. You're not the lead sponsor on it either. Not saying you're actually absconding on your responsibility to make sure that the investments actually perform the way they should be. What we try to do is we try to actually pass as much of that down into the operating entities, and then we overlay that in terms of external service providers. We don't have internal engineers. We've got legal counsel on retainer. We've got HR specialists that can assist us with certain things. We've got marketing assistants, specialists can assist us with marketing activities, with the normal PE stuff. But the joys of investing in infrastructure business, sometimes you build a machine, it's working, it's got a 20-year offtake or 30-year offtake. You don't have to go sell another widget. You just need to make sure that thing continues to perform and make sure that you, from a legal compliance perspective, you stay as far away from the termination clause as possible. And remedy issues with the management teams and your co-investors to stay away from those EODs, etc., from the banking perspective as well. So we are leveraging on this ecosystem that has been developing, and now the balance is to say, well, the interesting conundrum is what you insource and what you outsource, and what core competencies are your investment strategy based? What do you need to know? What is the key value drivers and the value structures in the business from a fund management perspective? And you want to kind of make sure you have as much of that internally, or if you can't find it internally, then you have the best of the best to assist you in those things.
There's a question from Henri as well.
Yes, Henri de Villeneuve from Cobasa. Just returning to your general presentation you made, do you think that the big numbers you use for country is still meaningful for investors? That means, first questions, it means just, you say Ethiopia is a place to go. In France, it's a place to go. I've been many times in Ethiopia. It's a hard job to invest in Ethiopia. It means, for me, it's more fragmented. In each country, you would have good investments and bad investments. Second thing, in terms of due diligence and risk assessment. Each time you make due diligence, you have a list of risk, 3-page, 4-page, and so on. You see the job you can do will be for sure to provide the risk, all the risk you can take, but just to make a separation between the risk you can take, depending on your business, and the risk you cannot take. So it means it's a mid-term between due diligence and advisory.
I'm going to answer the first question and then hand over for the second one. Thank you very much, Henri. I think you're absolutely right on your first question, is that data analytics, as we discussed earlier, is very limited in scope in terms of actually addressing very broad questions. Just because a country is growing at over 6% GDP growth does not mean let's all rally in and join on the bandwagon. More interesting, perhaps, is precedent of foreign direct investment. Remember that chart that I showed you of top 5 recipients of FDI? That's potentially more interesting, particularly if you start to then digest and see in which sectors has this been going. Has it only been going into one mining project? Like Sierra Leone's economy 8 years ago grew by 110% in 1 year. That's only because of the Tonkolili iron ore project. So starting to digest information on a more granular level, absolutely. Yet, data does have warnings. Everyone, lots of organizations, the AFDB, the IMF, the World Bank, many of the commercial banks here, etc., have their own data processing analytics units. But they are still useful, particularly in trying to forecast where you can see currency and convertibility risks emerging over time. If you see changes in inflation, if you see changes in import and export imbalances, you can start to forecast if your project is going to be affected by a sovereign risk, by a political risk, or even a security risk. So it's limited to what extent data analytics is useful to answer broad questions. But if you dig down a bit more, particularly as you mentioned, visiting the country, knowing what you're talking about, knowing local stakeholders, and conducting fair due diligence,
All of those tools together should provide a useful way forward, I think. Maybe on your second question, I wanted to hand over to the panel as well. Would you mind just repeating your second question, Henri, so that we can have it refreshed?
As an investor, you have to choose your risk. You cannot eliminate, you cannot mitigate all the risk. And depend on each business in each country. It's a good company which is providing due diligence. I'm not speaking about information, check, imbalance, liabilities, assets, information, what you say. But about the risk, okay? The best advice we could have as investors from a company like yours is to say, this risk, according to your business, we can take. This one, you cannot take. And in each opportunity, it's not the same list of risk, okay? It means I have this experience from with not with your company. With other companies, we receive a list of risk and so on, and you can imagine in the investment committee you have to click all the icons, okay? And to move forward in any investments, okay, it's a hard job to convince the guys in the head office, okay, that we can take all this risk. And we need from people like you to say, no, like Bridge, this one you can take it. But it's quite unique for your business. It's nothing to do with all the business. And it's mixed of advisory and risk assessment.
I think but it's a broad comment, and I mean, there's a lot we can answer to that. Unfortunately, who would have guessed we're almost running over time? So, I think what we're going to do is briefly answer Henri's question, and then move into some closing statements as well. But can we keep the answers short, please?
Thanks a lot. What I say, it's a fact, and you can't undo it. More than that, there is no one template of putting up the risk. Each risk is unique to the entity that we have on the table. And we can only do service as a service providers to you by quantifying whatever it is, and we put it clearly. This can be mitigated, this cannot be mitigated. If you can be able to separate for you, the points that you'll be called to make decisions on, there will be fewer than saying that, but than having general comments. That's a fact, and I totally agree with you.
I would say corruption and regulatory risks can definitely be deal breakers. You know, if you think that tomorrow you won't be able to do, the portfolio company won't be able to do its business because the license is going to be taken away, then it's a clear deal breaker. So yeah, those two are important ones.
Maybe just to wrap up, thank you very much, Henri and Jeremy, for your questions. Maybe just to wrap up, maybe reimpose the 60-second rule from Graham earlier. The future of operational risk and due diligence. How do you see this changing over the next 5 or 10 years or so? Maybe 60 seconds each. Any ideas? Any particular order?
I think fund governance as a concept is becoming more and more developed. Before, everyone entangled corporate governance or fund governance into corporate governance, but people are understanding that funds are very unique structures, and you know they've got some points which need to be very specific for that. So we're seeing that structure really being developed. So the use of advisory boards and the role they play in just ensuring that they're protected on risks and that the fund managers are actually doing their job properly is really important. So yeah, I think that is something we're seeing more and more, becoming more and more developed.
The space is becoming more sophisticated. The investment committee will be called to look into more issues that ideally before that would not have gotten hold of. Because data is becoming interconnected, we are getting more data, there are becoming data analytics, more information about the companies that others were sheltered from, they're becoming available. And you'll need to have more sophisticated people in terms of equipment, knowledge, and experience to handle that. That's how I think it will be.
Yeah, I don't have really much to add to what the panelists have said earlier. It is the ecosystem around us has been developing, and it seems like this is a core pillar to ensure the long-term sustainability of the sector as a whole. I think without this, we've had some failures historically where this has kind of fallen flat. I think the sector is robust and managed to bounce back. but we just have to ensure that that this industry best practices gets developed to ensure that for the long-term sustainability of the sector as a whole, and also equip third-party service providers that can give the relevant levels of assurance to buyers and market participants that these minimums are in place within the sector as a whole.
Thank you very much for that. I think we've given you 75 minutes on operational risk management and due diligence. You would have guessed. If you are as famished as we are, we're all looking forward to lunch. I'm going to hand over to our chairperson again. But in the meantime, I'd like to thank the panel and thank you for your audience. Thank you very much for your attention. Thank you.